Hi, my name is Curtis Drake. Today I want to talk to you about permanent life insurance, also known as cash value life insurance. For the purposes of this video, I just want to talk about two different types of insurance. There's term insurance, which you're probably most familiar with, the most common kind out there. Term is purchased for blocks of time, and after that, you're done. You need to requalify or buy another policy. Typically, the data shows that only 2% of people that have term insurance die while using that policy. So the question is, what's the most important type of life insurance for you? The answer is, universally, it's the type of insurance that's in force when you die. So one of three things typically is going to happen to you as speaking to anybody in the United States. So first, you die too early. Second, you get sick along the way and you need some kind of help. Third, you live too long. So for planning purposes, we're going to look at three things and how permanent life insurance is going to help you out with any of those. First, what is the structure? For illustration purposes, I'm going to talk about a universal life product that we sell and how that's structured. So hopefully that'll give you an idea. For this purposes, we're going to just talk about the index universal life. So for a universal life product, you're going to put in a block of money. Part of that block of money is going to go to the cost of insurance. Over and above that, what we call overfunding, and overfunding is a term used to anything above the cost of insurance, is going to go into the value of the policy. That accumulates over a period of time. It's got an indexed return or a return that's paid out by the insurance company to you in your policy, and it helps the cash grow within that policy. Using the cash and the money that you're putting in, typically we're going to plan on a period of years. Let's say you want to work for 20 years, and after that 20-year period, after that, you want that policy to be in force for the rest of your life. How can I say the rest of your life? I don't know when you're going to die. You don't know when you're going to die. Typically, none of us know when we're going to die, right? My grandma, for instance, died just short of her 102nd birthday. Long time. My dad died suddenly when he was 46, right? So a tragic kind of contrast for me. I don't know when I'm going to die. So I just need, did I say that enough times? If you overfunded the policy after those 20 years, then what happens is that cash value continues to pay for the cost of insurance while you're not working and while you're, in your retirement years, let's say. And then what you do is you continue to either take that money out in the form of a loan, and as that loan comes out, then that's coming out tax-free to you. I'm being very brief in this intentionally so we can talk about this individually. What that does is give you a supplemental tax-free retirement. Illustrate that out. Let's say we don't know when you're going to die and you want to illustrate that for the rest of your life. Typically, we're going to do that till you're 120 years old. So typically, we got you covered at 120. And so that money is going to go down, but it's still gaining interest as it's in there. So it's a block of money. It's what's left in there is gaining interest, and that's continued to sort of fund the policy, and that's going to shrink eventually. You're going to take that money out based on the illustration, based on the time you start, the time you finish. Death benefit is always going to be in place. The death benefit is always going to be greater than the cash value. Let's say you live till you're 100, right? You're going to have exhausted probably most of the money, and then there's going to be a death benefit in the end. After the 20 years, you die in the 21st year. Die too soon. There's a death benefit. One tax-free check, lump sum, goes to your beneficiaries. Let's say you get sick. Second, let's say you get sick along the way. What does that mean? Chronic, critical, terminal illness riders, right? Called living benefits. Every 66 seconds in America, someone gets Alzheimer's. What happens when you get Alzheimer's? Well, you're going to have to go into long-term care. There's a chronic rider in a long-term care that's going to not be a long-term care, but it acts as long-term care. We're going to get a check to help you take care of some of those expenses along the way. 22 seconds, someone's going to get a heart attack, cancer, stroke. What happens if you have a massive medical bill? Do you want to take out of your retirement savings, or do you want to have an insurance policy that will accelerate that benefit to help you out? Again, that's going to come to you from the insurance company as part of the benefits. So you look at the insurance as a supplement, as a backup, as a backstop to help you out. 3, you live too long. Remember before I talked about my dad and my grandma? My dad died too early. My grandma lived very long. 102 is very long, in my opinion. So during those times, what we can do is we illustrate out from the inception of the time that you want to start taking money out of the policy. Again, that comes back to you tax-free in the terms of a loan, right? So you're borrowing against the policy. The cash value in there is still accumulating money during that time, and that's why we call it a tax-free retirement, and it comes into you. This is supplemental money for your retirement. So one of your sources to help you out. As you live too long, in other words, you live a nice long life, what will happen is you'll continue to draw out of that money during the course of your life. And at the end of your life, whenever that is, there's still a death benefit to help take care of your family. I'd love to work with you. Thank you.